See, I stopped that music just 1 second too short. And Jeff was like, hey, both of you guys, since I'm the youngest guy here, you guys are proper Gen X guys. You remember being in the club dancing to that song, like, right? True or false?
All too well.
A little bit. If you remember it that well, you weren't really in the club.
All right, so welcome to Benny and the Squirrel. This is our first time we've had a guest on. My partner at Wall Street Beats and my good buddy Jeff Macke, Mr. Consumer, a Midwest guy, native like me, who also lives in California in the later stages of life like me. And we're here to talk about the consumer. You know, like 3 weeks ago, I had this idea of like, maybe we should buy tariff names and consumer names. I started talking to Jeff about it. And then I called Jeff the week before the Black Friday week, and he couldn't have been more bullish. That's been a good look. So welcome, Jeff. I'm glad you're here.
Thanks for the intro. It's nice to be here. It's nice to be right every once in a while. Nice to meet you, Squirrel.
Thank you very much,
Mr. Squirrel.
Listen. I mean, you're a pretty well-known guy, but why don't you give literally the 30-second summary about how you learned your trade on the knee of your dad, who was the CEO of Target? And,
I was the CEO of Target. We used to just go around from Target to Target. That was kind of his thing, to be a CEO. Then, as now, you kind of had to be into your stuff, you know? And so what he wanted to do on weekends was go shopping and just kind of torture or praise the store managers as he saw fit, you know, and he would kind of beat them up in public if the Target was messy, and then give him a little note in private. But that was the way he rolled, and that's the way kind of good retail does roll. You got to be a little punitive, and the stores tend to look better if you do that. And, you know, it's from there. I've done a lot of different stuff. I had a hedge fund. My first job was in retail, actually at Macy's, which I worked at Macy's. I ran men's suits and shoes back when you actually had to put the shoes on other men's feet. And it's been some therapy, man. That's PTSD stuff. That's Tiger Cage. That's John McCain crap. That
was my first job too was selling pots and pans at Harrods in London for Christmas sales, January sales.
Everyone should work retail for just a tiny bit of time.
That's amazing. That's very Gen X of you, by the way.
And then I upgraded to luggage, and I've been obsessed with luggage ever since.
Yeah, you know stuff, right? Like I can still fit a suit. I know how to fit a shoe. I don't put them on other men's feet. But you know, my son was really impressed. I'm like, oh, you gotta fit it in the arch there, son. That's where it matters. And he's like, oh, you know a lot about shoes, you know. It's a craft of sorts. People should work retail long enough just to realize they want to do something else with their lives.
Yeah, absolutely. So listen, Jeff, we've all been beaten around the head by economists telling us about K-shaped economies and the US consumer below the sort of first percentile being utterly doomed. You're going to call us out on that thought, aren't you?
It's kind of just not true. I don't mean that in a mean way. I mean, it's hard to really tell exactly kind of where it comes from. And, you know, if it bleeds, it leads, right? I sent you guys a chart from Gallup today where they're looking for a $200 reduction per capita in holiday spending. At this point, honestly, after the hard data we've seen from like credit cards and people that actually do the research, like folks would actually have to return stuff to spend $200 less than last year. I mean, that works out to 20%. That's crazy. This article is published today by Gallup, which is a semi-reputable place. It's not just fully mashable click porn type of stuff. And you know, I don't know why the sentiment's so negative. Dollar General beats today. It's not bad if you're a huge mass market merchant and you're selling more discretionary stuff. It a little bit might just be sort of schadenfreude classist. Like you always see when Walmart reports, people like to think that they never go into Walmart, and truthfully, most analysts probably don't. I was raised in these stores. I go into Walmart all the time. I was literally at Walmart yesterday, admiring the inflatable Santas and hanging out with the good people of Encinitas, California at the Walmart, just because that's where the consumer hangs out, you know, and they're shopping. They're always choiceful. And the truth is, every year is the best Christmas ever. This is honestly, like, in terms of to Ben's point, like, this is a Hallmark movie in terms of the level of suspense. It's going to turn out, you know, I think they're going to get married at the end. That's how every Hallmark movie ends. You know, I think Santa's going to show up at the end of Christmas. It's going to be the biggest Christmas ever. It always is because of inflation.
Well, isn't that just a nominal effect, right?
Sure. That's absolutely part of it. Absolutely 100%, you know, and you can nitpick it and stuff, but we spend just a little bit more every year. and kind of whether it's nominal or whether it's not. And this year it's particularly fuzzy with the tariffs and everything else that's going on. For sure, prices have gone up. We also just went up 10% over over last year. So I don't think prices have gone up 10%. I think the overall spending is going to be pretty robust. We're hearing from the retailers themselves. I also sent you a chart of Walmart. Walmart had strong earnings. Their margins were good. American Eagle had terrific margins. That's entirely denim trend. They're just not that good a merchant. But at the same time, if these company after company keeps reporting good margins and solid earnings and decent traffic, not great traffic, is it exceptional? No. But as it turns out, we've been doing commercialized Christmas for at least 50 years in this country. So it's really hard to post super huge gains over year, but they showed up. It's not the recession, and I don't know why people want to insist it is, but as long as we keep framing every good result as an outlier, then the easier bet is just betting on the bullish side.
Yeah, and I think that what it is, and I've thought about this a lot lately, is that if you think about the way that this year evolved, we get a new administration that comes in and says, hey, you know what we don't like? We don't like immigrants. So they take an anti-immigration policy. They kick some people out, but really they scare a lot of other people who leave. Then we get like some of those people just leaving. And you know what you do when you leave a country? You don't worry about paying the bill. And so you get the First Brands and some of these credit worries that were really catered to that part. You get the student loan collections actually turning back on. Biden and these guys didn't have it on, and they turned it back on. That is a squeeze. And then you got the tariffs, which wasn't really a squeeze necessarily directly on the consumer, but it kind of was in the sense of like costs went up. And so you have that like triumvirate of things. And then the government shuts down, the biggest employer in the country, right? And so if you think about when I called you, and I was really just trying to hedge my bonds when I was like, hey, I'm going to buy consumer because it was like and terrible. And the squirrel and I were long the Goodyear tire, and that didn't work that well for us. But I got back long it at 770. I was like, you know what? I'm buying it again. I'm back in. I got hit. But it was just a tariff basket, consumer Dollar Tree, Five Below. And I like the deck. I bought the deck on the earnings and had to take a 10% hit. Now we're back at 95. Do you think that it's kind of that? Like the government shutdown ended and you had all these other things which are significant, but maybe the underlying economy is okay, but it's just hard to decipher it. And we don't have the data to do it, and then people are raising prices, but volumes are whatever, and it just under the surface, what you see seems like you're bullish. So I don't know, like
it's because there's kind of two different things going on there. One, consumers spend what they have in their pocket, and you see that when you shut down the government, that was a genuine problem. That's a real live problem. It's a total self-inflicted error, and we needed to turn the government back on. And what you saw there was that went from the kind of narrative was, these, we had welfare queens again, which I thought was debunked 40 years ago. I thought that was just a remnant of kind of the idea that people were somehow.
We've got Silicon Valley is the new welfare queen. Come on.
Exactly. It's like there are easier hustles than green stamps. Of course it goes on. Of course there's corruption in these government programs, but for the most part, it's a silly thing to do. And the second that resulted in airlines being delayed, that second that hit that corporate traveler, then you started getting complaints from people that the government actually does listen to, which is Silicon Valley and McKinsey and the like. And they just said, you know what, if your flights are going to be delayed to the tune of 20% fewer flights, screw it, we're keeping all the consultants at home this year. And boy, that ended it fast. Once the rich guys started getting inconvenienced, that ended the shutdown fast. What we know from the past shutdowns is the spending starts right away. It gets pent up exactly the way you would assume rational human beings. If you cut off their money, if you cut off their funds, they're gonna spend less because they don't have money to spend, and then they go out and they shop for food for life.
It's a bit like the transmission effect down here in Australia, because everybody funds their mortgages at the cash rate, and the moment that moves up or down, literally it's disposable income, and the impact and the transmission is immediate as opposed to the lag that you see over in the US. I mean, I think, you cut off government paychecks, that's the brakes.
Right. And to Ben's point, are these crazy bastards insane enough to keep the government shut down through Thanksgiving? That was really kind of your downside. And that was what could really derail my entire let's try to be optimistic about Christmas, which seems like honestly it's betting on the Globetrotters. It's like, holy crap, I think the Globetrotters are going to pull this game out. In terms of like, you're going to win that bet. It's betting WrestleMania. I think the Hulkster's going to get this one. Yeah, they don't even allow these type of wagers because it's a pretty simple layup when people get that negative before the holidays. But it was a possibility. Once they turned it back on, then you had, as Ben knows, I always say, I love my negative catalyst to be defined and in the past. That's beautiful. And we've already seen it. We knew Delta was going to come out and say, you know what, this cost us X amount of cents in the quarter. It didn't matter what that number was. Who gives a crap? I think they came out with 26 cents. It's fine. I believe them. That seems reasonable to me. They could have said any number. It didn't do anything to the stock, which is entirely the appropriate reaction because it's a one-time negative that goes away almost immediately. That's the same thing with the stores. That's the same thing with consumers and the government spending. And a lot of these kind of negative inflows aren't really real. What people say to pollsters is another example of just, if I'm filling out a poll, the chances are that I'm just looking to vent my spleen a little bit about something that's pissing me off. So you've got this negative bias all over the place. The University of Michigan poll has been down 50% since basically COVID started, or like 2009. Your data's broken. What the hell are you doing? Like your data's broken. I'm sorry, but your poll is ruined, Michigan, and your football team sucks this year. There's nothing we can do about either one of those things.
So this chart here is this Father Christmas, Santa Claus fighting off the Head and Shoulders on the XRT?
There's a little bit of a selfie, and he's kind of just shrugging because it's like it's a fine chart. This is just not something that screams to me, get out there and short the living hell out of it. This is the year to date. You can see there at the beginning, we've spent the entire year right where it starts going downward to the right, really steep there. That was actually to the day when the White House posted we were serious about all that tariff crap. Like, we're really going to do this. And we went straight down into Liberation Day. And it's kind of been struggling to get back since. But as we're seeing now, between kind of the delays with the tariffs, the implementation's been a little soggy. They've managed to mitigate it to a degree, which simply means we're going to grind it out of our suppliers. We're going to raise prices kind of a little bit on the margins, and we'll see how that goes. And we're going to split this up, cost up. And, again, it's defined. And as long as, once we stopped with the racket of adjusting the tariffs all the time, we got to about August. That was kind of, that was a prior nadir of consumer sort of sentiment, the last little gasp. And that came with the end of August. We're going to really jack them up again this time. The sort of randomness you saw in furniture, that killed the Williams-Sonomas of the world, the Restoration Hardware, or RH, whatever they call themselves now, if they're an experience company. But those groups are really kind of still screwed. Those stocks have had a hard time getting out of the way. But if you look at the discretionary in general, we spent most of the year just trying to get back to January. It's up 6% for the year. This is not just a screaming bubble that you really want to take all of your downside shots at. I'm long AEO from when it was 11 times forward earnings. It's a 30-year-old company. They're not going to die. They're not going to go out of business. And so it just seemed like kind of a reasonable shot. And I kind of got long at the second I saw Sydney Sweeney because it's like, wow, they're going to sell a ton of jeans. The rest of it's just noise. They're gonna, they're part of the national conversation for the first time since the 90s. That's super bullish for a merchant that's in the mall and selling at 11 times earnings. That means more people are going to come in the store than came in before, and that's a guide up.
It actually reminds me, when I was in grad school, Phil Gross, who used to be at Harvard Management, and then now he has a big hedge fund in Boston, he was telling us about how they did healthcare and then they did retail. And I remember him telling me all the implied valuations based on this and that of American Eagle. And I was like, wow, that's who I got to compete against in the market. And that was the last time I thought about American Eagle until you got me long at $13. It's been a good stock.
I was working out at home and I saw the ads and I'm like, holy crap, that's a really good ad. And it had nothing to do with it. It wasn't a dog whistle. It's a good ad. It's a good ad that was playing off Brooke Shields ads from Calvin Klein when she was wiggling around at 14 years old, being legitimately offensively horrible. It doesn't date well. You can look it up on the internet on those sites that you probably don't want on your internet history. But, those were creepy advertisements, and they tripled Calvin Klein denim sales. Like that was the entire riff. Was it's just, but it was a nicely done advertisement that created controversy. It's the most clothed Sydney Sweeney has been kind of before or since. And they created this craze, and denim was already hired, so they tapped into the zeitgeist and they tapped into a trend, and you saw that trickle through. Ben knows I've spent kind of the last 5 or 6 months just obsessing over how I can make money from the fact that the growth of denim went from like 3% a year to 5% a year. That's all
So
you
this
need,
is- this
and
is your
that just
chart.
trickles through.
Why don't you walk through your charts here, your denim versus athleisure indices?
There's just long a group of denim stocks. So I've got Levi's in there, I've got American Eagle, I've got Gap. Between them, the theory is pretty simple. It's these are kind of the between the three of them, top 3 or 4 sellers of denim in the US, just in terms of the percentage of denim that they're selling, just ways to get long what is kind of an obvious fashion trend. And I love a trend. I work backwards from, you walk around and this is what you see. You see more people of both genders, young and old, walking around in jeans than did the year before. It's
And
not something.
why against athleisure specifically? Is that because everyone's taking GLP-1s instead of going to the gym?
No, you would think that would work. Actually, an athlete, do you think you'd want to wear tights if you're getting a little slimmer? But we'll get to athleisure when we talk about the restaurant stocks, or we'll get to the Ozempic craze anyway. But it's trends come and go. It's denim is essentially the product that's why your grandma tells you to never throw away your old clothes, because your denim always comes in and out of style, and it'll just go away for a while and then it comes back. And so it's fashions come and go. Athleisure actually won. I was on Lulu years ago when people would call me horribly offensive things for wearing pants that weren't wool, like in New York in the middle of the summer. I was wearing breathable fabrics, and they would just be like, "Oh, who are you? Some kind of 80s rock star?" Athleisure won, and it became just sort of a staple. And so that means that it's a regular product that's going to go in and out of style over time. And it's just been ruthless. You can see in the Lululemon chart, that's just been a downward murder pit for the last 12 months. Those sales are going someplace. That's about a $12-15 billion retailer at this point. That money is going someplace, and where it's gone is just denim. It's not a huge change. Again, we've gone from 3% to 4%. The numbers aren't exact, but they're still in the single digit in terms of how much denim grows. So this isn't a huge move, but it's a huge move if you're the Gap. It's a huge move if you own Old Navy and you sell denim at the Gap. They reported a quarter. They took a ton of credit for boy, they said their marketing created all this buzz and all this chatter. It's a trend. It's a tailwind. American Eagle's still kind of the same merchant they were before. It's not a stock you fall in love with, but it's one that you could absolutely play that trend. And they were selling at full price.
Great. Jeff,
it's
you
been
got
great.
Up along that. And I remember seeing the P&L. Kudos to Nadine. She was like, and we were on Wall Street Beats and you were pitching it. And she's like, yeah, this sounds good. And I was like, what are we doing here? And then I went back and listened, and then I called you. I was like, all right, we can go with this. That was like $13. It's like $22 stock now. There's don't apologize for 100% gains in less than a year, right?
I've been doing this too long to take victory laps as well. So I'm neither apologizing or really claiming that I'm omniscient. I'm just pointing out that this is kind of how you grind out a living in this business: is you find the trend and you figure out ways to capitalize on it. And this was a good example. And what happened with AEO, for all the controversy and hype, they sold out of the Sydney Sweeney stuff in like a month. They would have crushed it. They got on the call and kind of sheepishly said, yeah, we were sold out. They had demand for denim was up 50% for them. It's hard for them to screw it up. What they really sold a lot of were undies, and they used that as a term, and I'm slamming air quotes on it because it's super creepy and it feels gross just coming out of my mouth. I'm sorry to people who are watching.
They
just kept saying things like, undies are really hot this year. There's nothing like undies in your basket to me. And you're just sitting there like, oh, my ears, my head. But the Aerie division of American Eagle was terrific. So in other words, they're getting people in the store and they were spending, and they also got Gen Z to spend. And so, like every other trend that you see, you can find Gen Zers that aren't spending. You can find people that are complaining about it. There's the Wall Street Journal. That's just a couple of days ago. So that's after American Eagle said, Gen Z problem. What the hell are you talking about? They're literally lined up out the door. We can't stop selling things. They came in to see Sydney Sweeney stuff. It wasn't there, so they just bought undies. It's people are clearly shopping. They're just not shopping where they were before. And so whatever they're saying to the pollsters, the truth is retail tends to be a little bit of a zero-sum game. It's a little bit of a grinded out, low margin business. But it's a sentiment game as well, where you get these companies that get left for dead, and you buy them when people give up on them. American Eagle, it's really easy to give up on them last year. After Q1, it was terrible, but they turned it around. The way they turned it around was they got more customers in the stores.
It's funny because I liked Victoria's Secret the moment that they went from the we're promoting fat chicks to like we're going back to our normal thing. And don't cancel me, I'm sorry, but I'm just saying that was the bottom. That was actually the bottom, and the stock's gone from $17 to 42 cents. But let's talk about the spin-off of Victoria's Secret, which I actually just bought this week. And Berna, one of our other partners at Wall Street Beats, Bath and Body Works, right? An old school retailer, mall traffic. It's been left for dead. I pitched you guys on that. I was like, oh, this looks cheap at $32 last January. Well, it just hit 15. I bought it at 17. Is that the kind of thing that also, you were telling me buy Abercrombie, and you're like, I'm scared because everybody's scared when this is down in the right chart, but it went 66 to $100 pretty quick. Sometimes these things
super
can happen fast, right?
That was one that's 7 times earnings. And Abercrombie itself, it's 2 companies, just like Limited and Victoria's Secrets were. And it seems like at Abercrombie, they can never really get both of them working at once. Hollister, the sister brand of Abercrombie, is unbelievably hot right now. Lines out the door. That's where Gen Z is shopping. Abercrombie itself is terrible. I almost bought a Def Leppard t-shirt there yesterday because but I didn't know people would think it was ironic or not. But I don't think Def Leppard's moving at Abercrombie or anywhere else, but that's the kind of stuff they do when they get a little offbeat, and it's not working for them. But Hollister's doing really well, and so they reported kind of a perfectly cromulent quarter. But at 7 times earnings, that took it from 60 to 100 in an hour. Now, it's probably not going to stay there because there was a lot of squeezing going on. But, again, these are bets that you make. You don't fall in love with these stocks, but you can certainly date them.
Yeah. So you're shooting another popular fox at the moment, which is that Gen Z don't buy stuff, they buy experiences. You're calling BS on that, right?
I'm calling absolute BS on that. Basically I'm calling BS on people change at all, ever. We're basically just big stupid animals that never change. And so, you change on the margins, but our boomers had the same impulses. It's gross to think about your parents having the same impulses as your kids or you when you were a teenager, but you know what they did? As they get a little old and white bearded, I realized that, so of course, Gen Z, it's people buy things and they like what they like. And this year in particularly, it's the consumer is choiceful is kind of loser speak for we didn't have the stuff that consumers wanted. And you can see it kind of at individual companies. You have any?
One thing I would say, did you see Marriott today? Marriott got dirt napped today. There is a real thing that could be like what Rupert just said is the experiential, which that was a trend for a decade. Well, you know what? I'm looking at trips in the winter, and flights are ridiculous and hotels are ridiculous. So maybe that Instagram inspired experiential thing, now they took too much price and people are now going the other way, right? Where they're going to localize. What?
Oh, that was my phone ringing. I'm sorry. It's my wife calling. She's probably calling to tell me she heard me on the podcast. You sound great, honey. You're doing great.
But you know what I'm saying? Maybe prices got taken too high by hotels and flights. And so that whole experiential thing, maybe that trend is over and it will go back to maybe, we're going to buy stuff and be local a little bit again. I don't know. All I know is everyone's telling me malls are packed with kids. That's all I hear.
Packed. I get text messages from around the world. Everyone likes to talk about the retail experience and no one really wants to hear it except me. I eat that crap up. And so as a result, I'm getting texts. My buddy Lance sent me a video from Scottsdale. He's like, look at this. He sent me a video of the parking lot. I don't know who else his audience would be except for me in that, but he's like, look, it's all packed, super crowded, super crowded. You know, a lot of people be bored by that. I was like, yeah, hell yes, Lance. You know, give me more. Tell me more. Which stores were crowded? I went to, you know, it's the mall out here, you know, in San Diego is a pretty robust economic community. They're always crowded. It was packed. It was full of Saigon type of chaos. You don't really see that kind of traffic. You know, I mean, if you've been through a couple economic cycles, you get a little old, you can tell the difference between when people are really out shopping and they're not. It's a social experience. It's an experience unto itself. You're exactly right in terms of they took too much price on the Instagram. That happened in Vegas. That happens kind of all over the place.
Exactly. You heard Caesars being like, hey, we can't do $20 bottles of water. It's like, no, you can't. I don't know whoever told you that was a good strategy, right? And so taking so much in terms of room rates and prices within the ecosystem of, you know, $10 waters at the airport, $800 flight. Like, look, I literally just was like, you know, looking at flights to go back to Thanksgiving, my girlfriend's place in Detroit. It was like $1,700 to fly from LA to Detroit. Like, what are we talking about here? This isn't Costa Rica. Right. This is not the Maldives. We're talking about Detroit, right? Like,
and so your bet choice there becomes, okay, you know, people who are rejecting the $1,700 flight to Detroit are behaving in rational economic ways. That's a timeless, like, gee, that seems like a lot to pay for something I'm not going to enjoy that much.
100%.
For the last million years, that's been a crap thing to try to overcharge for stuff that people can get elsewhere and do better, more fun things for less money. Forever. Either that or Gen Z is just a bunch of freaky different animals that we don't understand at all, and they don't enjoy things, so they're never going to shop again. One of those two things is, you know, accurate. I'm going to bet that we're all just stupid animals, and we're going to kind of go where we get the most economic bang for our buck. That, you know, that's going to shift, but so you don't need a huge Christmas. You just need to know where it's busy this year. And this year, it turns out that basics are doing great. Athleisure can't get out of its own way. Anything kind of sporting can't get out of its own way. That's bad news for Nike. It's bad news for Dick's that just bought Foot Locker and is an absolute hell show full of unbelievably marked down Nikes and a tiny bit of On Cloud. You know, it's even bad news for kind of On. It's bad news for Deck. That stock's been murdered this year. They haven't done a ton wrong other than just spending years on top. But, you know, they've got exposure to kind of the Foot Lockers of the world that aren't doing well. On the other hand, stuff that got lost before, the Victoria's Secret's a great example. That was kind of the weak kind of sibling when that breakup happened. When LB broke into Bed Bath Body and Victoria's Secret was one that was in a lot of trouble. And they were really kind of culturally irrelevant. They didn't decide fat chicks, as Ben put it, not me, you know, were something they wanted. That was backlash because they went completely just garbagey way over the top with the Angels for years until that became ridiculously creepy. That was like Hugh Hefner's mansion creepy for about 10 years, and people couldn't get far enough away, and the cycle turned. You know, now we're back.
It's all cycle. It's right. It's deregulation, regulation. Everything's always cyclical. It's a wave function, and so you know what? Like too much experiential now goods. Too much regulation, deregulation, too much, you know, Adriana Lima. I'm not going to say whoever on the other side of that, but like, you know what I'm saying?
It doesn't. I mean, and you know, you go counter trend until it seems almost, you know, mind explosion that if we put attractive people like Travis Kelce and Sydney Sweeney in nice clothes and we have really good photographers take pictures of them, it'll move product. That was like a head exploding idea that American Eagle came up with, you know, which is you know,
no Madison shit. Avenue you'd never heard of before.
And yeah, exactly. Well, you know, what a great invention. We're gonna put these attractive people that folks admire. Look at that. Travis Kelce looks great in a sweater. Who would have thought that the 6'5" famous athlete married to Taylor Swift would be, you know, someone that folks would want to be like, and they'd actually go pay attention to him. But that became a great idea. Victoria's Secret's back to, here's some good looking people in our product. Would you like to look like this? You know, sure you would. It's attainable. Now that will of course age until it becomes horrible and hideous again, and the cycle will continue. But for now, it's not going to stop. For now, undies are hot. It's gross to say it, but it'll work for the stock. Victoria's Secret reports this week. That stock's gone from 42 at the beginning of this year to 14 during the Liberation Day, all the way back to 42. It's flat the hard way, man.
Do you think there's risk? So I will ask you, because I live in LA and I drive on I don't drive, actually, the Waymo, which the squirrel
Nice.
hates. The squirrel hates the Waymo.
I don't hate the Waymo.
You know why? Because they don't have the Waymo in Melbourne, Australia, where he lives.
Yeah, they're like
Waymo.
30 years behind. It's
California, they have
1978 in
the
Australia.
robot cars. But I drive past it every day, and there's the Skims, and all I talk to the girls, they all love the Skims. Is that a risk for the Victoria's Secret potentially? Like,
I don't know, man. I'm not sure people are ready for Merkins yet. Have you seen the Merkins from Skims? I
have no idea. All I know is I'm I'm not the guy. I'm just asking you. You're the consumer. You're our guest. You got to be the one to tell us about this.
I'm a respectable married man. You can't tee me up like that. I have no idea what product you're talking about. I took a family survey of the Skims, though, as we were spending family time together, and I passed it to my wife and daughter, and I said, you don't have to tell Dad, but I'm curious. Their consensus was it's a little gross. I don't think it's quite mainstream yet, but man, they're doing partnership with Nike.
Well,
Nike
we've been talking cycles. I think the last time Merkins were popular, it was the Middle Ages. So that's a long cycle.
And so they're due. On the upside, they're due. They're absolutely due.
The most Gen X podcast of all time. All right, let's talk
Everyone's
about.
Googling.
I want to talk to you about restaurants.
Has been short the restaurants for a while. What do you think about the restaurants? Casual dining versus the QSRs. Let's go there.
Well, sort of full service, fast casual QSR. I think we can leave the fast food guys out of it. It's a slightly different business, but I've been short the full service and the fast casuals since midsummer. It's been a great trade. They're beginning to turn up a little bit. It's I had to close a couple of them last week. Really just on technical.
Do you talk positions? Because I like the short on all of them. I think like there's nothing wrong with Texas Roadhouse that a little beef price improvement isn't going to help. Isn't gonna fix. I think, but all these things are name specific. And if you look at the Cavas of the world, you look at Chipotle. Chipotle seems unbelievably lost. I mean, just incredibly, holy crap, are we lost? And I don't know why that is.
You say people don't like burritos the size of babies anymore?
No.
We'll call them slop balls.
Slop was actually the word of the year with The Economist. So maybe it's a bottom end slop, but I don't think that the $20 bowl of stuff that's the size of a baby is that hot. And Chipotle spent their entire last conference call really just kind of bitching that the consumer doesn't understand what a great value it is to buy 12 pounds of food for like $20 in as a single serving. And that's the wrong way to do the business. Maybe in an Ozempic world, no one really wants that. They're gonna start throwing up on themselves. That perhaps we should pursue a different line item. I think they ran their course. Kava came out. It was so expensive to begin with as an IPO that I think it tripled just on the fact that no one could believe anyone was paying that much for Mediterranean food. Speaking of things that we haven't just discovered, it's like, oh, gee, here's Mediterranean food. Yeah, I didn't like it before. It makes me burp. I'm an American person. It's gross.
You don't sound like a guy who's been to Greece. The Greek salad in Santorini, in Patmos, in Mykonos, very good. I'm just saying, don't hate completely. And as a guy who lived in Sardinia, I'm just trying to defend the Mediterranean just a little bit here.
See, yeah, not to get regional, but you Wisconsin guys are weirdos with your exotic taste, your Germanic, French-leaning tastes. I'm more of a Scandinavian type, Ben. I'm more of a Viking kind of guy.
You are.
I don't know. It makes me repeat. My point is, it's not really a mass market food. You don't need 12 pounds, but it's Chipotle is just one of those shorts where, Ben, you and I were talking about Lulu. I think it was like June. Someone downgraded it, and it seemed so late. It was at 220. I think it was JP Morgan downgraded them.
Yeah.
And it seemed kind of embarrassingly late, but not wrong. And that's kind of where Chipotle is now, where it's just like, it's late
still kind of expensive. Like the multiple is still kind of high, right? Like this CEO is clearly not going to be the CEO in 2 years, right?
No.
And so, when you were on my old podcast with Nadine, we talked about it last August, right after Nichols had left Starbucks or left Chipotle to go to Starbucks. And you're like, hey, look, they front loaded the Nichols premium, whatever it was, and that was a harder ship to turn. But like you were like, yo, it's obvious Chipotle doesn't have any. There's no low hanging fruit anymore, and
No,
it was a pretty obvious short, but it's worked quite well.
I quite like to look at sort of valuations through a different prism. And for Carver and for Chipotle, I was looking at just market cap per outlet, right?
Mm-hmm.
And I grew up in the restaurant business. My mother and stepfather owned a restaurant in London, and at the peak, Carver was valued at $25 million per outlet, right? I can tell you, my stepfather didn't sell his restaurant for that, but I get that there was this ridiculous total addressable market extrapolation about having thousands of stores everywhere by the end of the decade, but that's not how you value stocks.
No, and that brings us back. Chipotle is doing something, and they announced it in the last call, which was that I have very few hard and fast rules, but one of them is don't expand when you have negative comps. If you're posting negative comp after negative comp, stop building new units, because there's something wrong with your model, and it's not going to be fixed by putting one right down the street. And Chipotle is openly saying we're going to keep opening new units, and we do see a downturn in the existing units when we do that. But over time, the basket will get bigger, and it's like, what?
Isn't it the same as we're going to make it up with volume? Right.
Exactly. It's like, holy crap, that you're just screaming overvalued to me. So between yelling at the customers and just kind of that, again, it seems late to short it, but it seems really long to buy it, because they're going in precisely the wrong way. Your multiple is low because the earnings part is going to go lower. That's been the case with Target. When we talked about it in the note before the show, these companies where the earnings are still falling, they're not cheap. They're value traps. That's the definition of a value trap. And the earnings are still going to go lower at Chipotle, as long as their strategy is, we've got new store coming, and it's got a drive-through. And that drive-through is going to change everything. People are going to want to hoist the 20-pound burrito in through their car window and give us $50 for it, as long as it's in their car and not something they have to walk up for. That's not their problem. The problem is the product.
And so Jeff, let's talk about this for a second. I'm going to add this chart for a second, because we've talked about this.
Where's the doodle? I don't understand charts without doodles. Is there a picture of Santa Claus?
I know. I'm sorry. I did it on a whim. I just had to pull the Bloomberg up. But you were talking about, hey, don't keep opening stores when you have negative comps, right? And this is Dave & Buster's. And we started talking about this, and I bought this around Liberation Day at like $15, right? And then I sold it, I don't know, 28, 27, 28, whatever. Nice trade. But like, now we're back down here. It is the same thing as Build-A-Bear, which when I was at Fidelity, I owned 15% of the company. You've recently been long that. And it reminded me of like how much I hated that. And just so everyone who's listening knows, this is a company that allows 100 dogs in their headquarters. Just dogs running around their headquarters. And they were, I had to school the CFO of like, don't keep opening stores. This is what's happening to your return on capital. Your liabilities are increasing. And yes, in front year, you front load these comps, but then they negative comp, and then they negative comp. And so I think that's, I'll take this off because I think people got the point. But like, that's basically what you're saying, right? Like, hey, fix your model, and you don't need 20%, 30% comps like Aritzia, which has been a fantastic stock that we can talk about in a second with you. But you need like 2 or 3.
You stop the bleeding, for sure. Stop the bleeding and just figure it out.
Before we leave restaurants, Jeff, before we leave restaurants and go back to more retail again, but is there any parts of the eating out universe that you like right here?
I think we're a little early on a lot of it. I super don't like the fast food. I think you're going to get an opportunity in the bros of the world, which is kind of an overpriced concept that is taking share. They're undeniably taking share. Starbucks, Nichols has got his hands full there in a way that I frankly kind of thought he'd be able to get his arms around a little bit. I think he has a problem with the workers. I think the store base, it's going to just take longer to turn that than he would have expected. And bros, I am not a fan of the product, but then again, I don't go to Victoria's Secrets a lot for myself either, but I'm willing to kind of buy anything. But for my personal preference, I would enjoy Starbucks more, but I think Bros is going to be where you get the opportunity. I think those concepts that are kind of working and taking share and just blocking and tackling are going to be the ones you want to buy. Texas Roadhouse, there's nothing wrong with them. In particular, it's a good company that ran up for quite a while, and it's going to base. I think that makes a lesser short. Starbucks, for that matter, I don't think it's a great short. I think it's just one that is just going to kind of buy time for the next 3 years. But, I think there's more meat on the bone on the short side on, the Kavas of the world. I don't know what stops that from going lower. You're going to get some wicked reversals, as you always do after huge declines. Great trade, by the way. But as that means you're due for a 20% kind of face ripper to the other side. The Abercrombie and Fitch shorts just figured that out over the last week or two. So there's going to be a reversal. But like you say, once you kind of look at the fundamentals of that, as long as the earnings are declining and as long as management is willfully going in a direction that just frankly kind of doesn't make sense, it's the easier money is kind of betting against them than it is long. And they just seem broken.
Benny alluded to the fact that you pack your passport occasionally, and well, not that far, but you've been having some joy north of the border recently, or the Ritzia.
And the retail side, Canadian. Yeah. It turns out they can retail a little bit. The Canadians, they came up with Lulu. That's a Canadian company. But in this case, we're out of Lulu and into Aritzia. I always like to belong to Little Canada, if only I can heckle them as a Minnesotan. But that's a good example of kind of, it's gotten pricey at this point, but it's having a moment. It's just now being discovered in America. It was a Canadian company, it still is, but they just now passed over the last several quarters, became bigger on a revenue side in the States than they did the US. But they're in a real sweet spot. What I like to see in my specialty retailers in particular is I like companies that really own a customer base. And that's where Lulu was at its highs. You would see kind of a female, a person, and you'd look at them and say, that's a Lulu customer. This is someone who you would expect to see in Lulu. This is someone you'd expect to see in tights. That's a customer that they own that's who they are. The Gap was that way when they were hot in the 90s. I think Aritzia is that way for young professional women. It's affordable luxury. It's achievable luxury. And so, in other words, we talked about my daughter working at City before. That's an Aritzia customer. That's someone who, it's a young professional who wants to look classy, wants nice stuff, willing to pay a little bit for it, but not get just hugely gouged. And so it's kind of that sweet spot in this idea of only rich people are buying or poor people, everyone in the middle is getting decimated. Not really. I mean, I think it's a matter of getting what you pay for. Aritzia is going to have a moment here. They still have a ton of runway in the States, which is where their money's get made. They posted 28% comps last quarter. I love owning retailers on the upside like that. Once this stock has already broken out, it's been a pretty big winner for the last year. But it's gonna keep going just on the operational side. And it's how's it
valued now? How's it valued now, Jeff?
Way too much. It's about 10 billion. I mean, it's super expensive and 30, but it's later than the bargain stage. But they've got a new CEO, a young CEO, who is kind of a mentee of the past guy. But she's terrific, really talented, and has really got the company pointed in the right direction. And again, it's gonna be a short nightmare. People are gonna want to short this thing so much. It's only traded on Toronto, so that's a catalyst. They're gonna move to the States and eventually trade here. That'll be bullish. That'll get more on coverage. But right now, this is going to be the Christmas where people are finally in the States going to be starting to hear the name, hear the brand, and get familiar with this idea of this company. And they make the best stores in the mall. And that's just a really powerful combination. I don't mind paying a little more for a company like that, particularly when they're posting 28% comps.
Right, which is
give us a ticker.
Right? That's how Lulu started. Lulu came in, Canadian company. All of a sudden, now we're like, who's Lululemon? Now it's Viore, which has taken the some of the thunder from Lulu. But like, when you have a powerful consumer concept that people like, people can't get enough of it.
Right.
You grow that as fast as you can, and you get the Jeff Macke Christmas Tree of Death chart, where I don't know what the time scale is, right? But like, it just rips. And I remember when I was in the early days at Fidelity 20 years ago, and Under Armour was that stock, and Crocs was that stock. You remember those days 20 years ago, guys? Like Gen X boys? And like those things were ripping. And you know what they did?
And they rip, and everyone knows how it ends, and they like to think they're
exactly.
So
the Christmas tree of death chart always happens.
Remember
Chico's is the same thing, right?
Chico's fast, and you make the money on the left side of the Christmas tree. Like when it's going up,
that's
the easy place to make the money. And then you just sell it.
Just very quickly, guys, what's the ticker on Aritzia?
AZTTO.
AZZ on TO.
TAF on Bloomberg.
Yep. And so, it trades. I always joke that Toronto Exchange is like two guys on a snowmobile and they meet a dog there, and the dog is the official in charge of the Toronto Exchange. It's a difficult buy is what I'm saying, but it's worth your time. But, and it's one of my favorite stories because, I discovered it with my kid. I'd love to, check out the brands and find them in the organic world and then go backwards on the research. I thought it was an Italian company. I'm not going to lie. We found it like 8 years ago. I was like, who the hell are these guys? What's going on here? So it took a lot of research and a little patience with the broker to get a nice position in it. But, it's one you buy and put in a drawer. And eventually,
let's go easy on let's go easy on your northern cousins, because we've got our favorite Canadian joining the show next week, Kevin Muir.
Okay, well, I'm sure he's a nice guy.
We love Canadians here.
I won't insult him, not in front of the kid from Wisconsin. I mean, we've got our own enemies here.
There it is, the Minnesota guy with Minnesota with the long O, which is much more.
Hey there, buddy. Hey, you back off, fella.
Look. At the end of the day, are you more bullish on the Packers or the Vikings here for the next 5 years? Like, let's be honest.
I think you got to buy the dip on the Vikings. That JJ McCarthy is a coiled spring. He's coming around.
Yeah, okay.
The Packers are the Dallas Cowboys.
Easy guys, I might start talking about Test cricket in a minute if you carry on with this. NFL.
Yeah, the English guy's like, I have no idea what you guys are talking about. Like, he's getting left behind. He's like, I don't know what's going on here.
I know. It's like a Sheffield Liverpool debate.
All right.
He's like, what the hell are you
let's circle this back. Jeff, the title of this was, is the consumer stocks bottomed? How do you feel about that? Like, Costco today was down a little bit, but I looked at the comps. It's like, okay, yeah, it wasn't as good as you wanted it to be, but they were still pretty good. You know what I mean? Like 5, 6, like those are still solid comps. So like, Is it like everything I said earlier, student debt, government shutdown, immigration, that was a perfect storm of like making you think that this was 2008. But maybe now that the tariffs are going to get rebuked by the Supreme Court, and that this administration isn't as tough as they thought they were going to be, and so that actually is this it? Like maybe 2 weeks ago, 3 weeks ago was the actual bottom. Like, what do you think?
I think Costco is an incredible company. I'm trapped long on Costco and Walmart. You've known that for a long time. I've been trapped on both those for years. I'm dumb enough to own them in taxable accounts, smart enough to have held them there. So, I can basically never sell. And until 3 weeks ago, Walmart, I felt trapped on. Now I just feel really smart about it. Costco, I feel like an idiot being long them. And I think it's a really good company. They flew too close to the sun. They became super hot the way Target did during COVID. Way too much buzz, way too many kind of young millennials saying, oh God, I went to Costco. I've discovered club stores. The truth is, it's a discount store that has a great model, and they're almost tariff proof. I feel Amazon's kind of the same way. They both had lost years, terrible years for the stocks, but they own the customer, and they're going to be able to lever that in ways that other companies can't. I don't know what happens with Target, but I know that Costco has so much of their money coming in from the membership that's just a great store model. Then TJ Maxx is another one that, as long as their magic's working, as long as that model is working, it gives them an edge. It gives them a moat, and it's a stock that you want to own. Is it a stock you ever want to trade? Not really. I don't know when Walmart's going to break out. I just know it's a really good company run by smart people. Now,
like Costco. Look, I learned this the hard way, just so everyone who's listening. Like, I tried to short Walmart. I told Jeff, I was like, and I think I told Squirrel also. And you know what happened? I shorted 50,000 shares of it. And then it went $7 the wrong way on me. And I was like, you know what? I'm bending the knee. Like, that's enough. Like, I've had enough. That was enough fun of trying to short Walmart. And, like, you don't short Walmart. You don't short Apple. You don't short Costco. And, like, you know what? Like, you maybe don't always buy them, but you don't short them. right?
And
like,
if I didn't own Costco at all, I would be kind of getting frisky on it. I would be getting, starting to look at it. It's not cheap. It won't be cheap for a while. But it's if you kind of look at a long-term chart, and that's a fair way to look at it because their business model, there's not a lot of mystery going on there. Well, Walmart did. The guy who's retired, I got to give him a shout out while I have a chance. Doug McMillan, he did an amazing job at Walmart. He took that from a sleepy 8 multiple company that was really kind of dying. It looked a little like Sears. That's been the biggest retailer in the world since 1989. 1989. That's a hell of a run. And, it was looking a little tired, a lot tired, as a matter of fact. Doug McMillan went in there and he raised wages right away, and he modernized the company, and they're actually making money online. Walmart does $80 billion online and they make money, which is just crazy. I don't know how Target's going to catch up to that, because 80 billion a year is the size of Target, basically, give or take, and by next year it will be. That's nuts. And so you have the stories there, you got the technicals there. It's an expensive stock, but are you going to bet against these guys? Because holy crap, that's a scary, you're betting against the Holy Roman Empire. Eventually you'll be right, but it's going to be a tough 400 years along the way.
And what's funny about that, Jeff, is like, I know you're so, you're biased to Target as your dad was the CEO and you're a Minnesota guy.
It makes me sad at this point, but sure.
I know, agreed. But that I get that a lot from my buddy Larry McDonald and guys who like look at relative value. They look at Target versus Walmart, and there's been just a massive divergence. But maybe it's what you're saying. It's like, hey, these guys are adapting to how the economy works now, not like relying on how it used to work. And yeah. Basically the reality is like, if you don't adapt in a complex adaptive system, which is what the world and the economy is, you get a divergent chart. Like if you're not adapting correctly. Bed Bath & Beyond is the best example of that, right? Nobody kicked ass more than those guys in the old world, but never adapted to the digital world.
Now, there's a lot of meat on the bone at Target. I've got ideas, as you would imagine, me being a know-it-all who grew up in Target. But, I'm a smug master with ideas sitting on the bench. But I tell you what, there's a lot of things Fidelki, the new CEO, can do to start turning that around. It won't be a buy until he takes the earnings down, way down for next year, because it's going to be expensive. They've already said that CapEx is going up by $1 billion at Target. That's about 20% of their free cash flow. So it's a big chunk of money. But they need those improvements. But if I'm walking through that store, they already look better under his tenure, and they're being a little lazy about the turnaround, which, they're polite, they're Minnesotan, for better and worse. But there are things they can do that make sense. They've gotten rid of kind of that woke part. The woke problem with them wasn't the headline stuff. It was that they were just they forgot who they were. They kind of just pandered too much to a customer base that they already owned anyway. And they forgot that the idea there is a clean, healthy store that appeals to everybody. If you're a mass merchant, that's who you've got to be. Target can get back to that, and they might be a winner next year, but not until they're going to have a huge guy down in February or March during their first investor day. They're going to say, you know what, we're not going to earn anything next year. Our multiple is going to go to 20 on a forward basis, and that's when the game is afoot for Fidelki. If they're going to turn around, it'll happen in the first quarter, and we'll see. I mean, if I had to make a bet for a year, if it was going to be kind of a long shot, no one believes in Target. I'd like to. I think there are ways that can improve it. I think there's low-hanging fruit, but it's going to take some work, and we'll see how aggressive he is. If I were him, I'd go total Michael Corleone. I would just kill the heads of the other 5 families and just announce his presence with authority and go after it, because they have nothing to lose at this point.
Michael Corleone, huh? All right, so let me finish with like this. Is that I was like thinking about this whole thing with the consumer, and like, the question that probably the people who are listening right now is, was this just a short cover? Was this like, hey, things have been destitute, and we've been partners at Wall Street Beats for 2 years, and you remember when I was pitching, and that's actually how I met the squirrel, because he was, he's done business in Asia, and he's lived over there for a long time. I was like, hey, you're the only other China bull that I like come across. And you remember when I was like, hey, be long China, and people were like, it's uninvestable. Well, that's kind of how I felt like consumer is. And so the first move of uninvestable up is short covering, right? So
Yep.
are we at a place where there'll be follow through, or is it just short covering and then we go sideways? That is what probably most people that are listening to us want to know. You know what I mean? Like that is what is actually the most important thing. Like we're all funny guys, and we can have fun and play Blue Monday, but like Jeff, tell us, do we have some follow on here, or is it just a short cover of everyone who's just it's overhated and we had to take some of that funding off to, basically cover our shorts?
I mean, the answer is a little bit of both. I'm sitting here all smug. AEO's up 40% in the last month. I'm not gonna sit here and say, yeah, this is the start. This is the very beginning. It's the the kernel of the growth seed here. But I think there's room to run. I think that the earnings are going to get better on a lot of these. I love the mix of. I love the headline flow. I love Gallup coming out and telling me people are going to spend $200 less at Christmas when they've already spent 150 more than they did last year. I love that just in terms of a short squeezing opportunity. It just sets people up too much, and you get that kind of money flowing in on the negative side. I like being long. That action in Build-A-Bear. They were short 20% float going into today. It fell 12, 15%. It wasn't a great quarter, but that's 13 times earnings. It's not going away. They're not going to cease existing just because the stock has had a nice run. I think names like that consolidate, but it's time to start getting constructive. If you're betting against Walmart, you haven't even started to get squeezed yet. Like that, it's when that stock breaks out, it typically goes like a 40, 50% run. And that's when Larry's going to be really pissed off about it because it's going to be trading for a 60 multiple, which will make no sense whatsoever. But it's got the technicals, the fundamentals are improving, and it's got a great narrative, which is we're going to capture market share for the foreseeable future. That's hard to bet against. Right now, it's once you start to see the turn at Lulu, as I said at the start of the show, retail's kind of a zero-sum game. You're going to grow along with GDP. You're going to grow right along with inflation, and you're going to shift from one pocket to the other. And what leaves Lulu's pocket, well, that goes right into the Gap and AEO. But as long as you have the Inditex of the world, that's the largest specialty retailer in the world. There's Zara over here, but they're everything everywhere. They just got it up and they had a 10% rally. When companies like that are doing well, Godspeed shorting them because they're not that expensive. They're huge, and they're telling you that business is better. They're openly saying, I don't know what the hell is going on with your headlines, but Gen Z's packed at our store. Maybe they're too busy shopping in our store to tell you that they're actually shopping right now. Maybe just the losers that are sitting at home are the ones that are clicking on your surveys. But there are too many kind of tailwinds going on. I've been really impressed with the way the retailers have held their margins in the face of tariffs, in the face of rising prices. The fact that they were able to pass a lot of those on in a way that didn't scare the consumer away. It tells you the power of trends. It tells you the power of sort of monoculture and the kind of meat that's still on the bone of online shopping versus off. There's too many tailwinds. So I wouldn't bet against the consumer here. Talk to me in 6 months. Would I bet on an endless rally from here? Absolutely not. There's going to be pullbacks, but buy the tips. Start looking at the Costco's, the things that seem left for dead. When everyone hates them, as Ben, that's the best time to buy. And right now, they still hate them a little bit. So I'm kind of comfortable being long here, or at least a little bit.
All right.
Perfect, Jeff. That was fantastic. That was absolutely fantastic. I great to meet you.
Great meeting you, my friend.
I'm glad I haven't got super focused on getting short retailers. I think I probably, listening to you, feel pretty comfortable staying short slot bowls, but we'll expect a couple of face rippers along the way.
Yeah, exactly. There's nothing wrong with a face ripper or a slot bowl. Just stay long and mix your metaphors freely. Enjoy, boys. Thank you. It was my pleasure.
All right, Jeff. Thank you.